Hey everyone. Before we get into today's interview, just wanted to drop a little reminder to stay up to date with all the latest episodes of On the Margin. You can subscribe to the Blockworks Macro YouTube. Just go up there, just click the little subscribe button, or you can click the links at the top of this episode. It'll take you over to Apple, Spotify, whatever your preferred platform is. Just subscribe there. If you could, leave a rating and review. Really appreciate it. All right, on with the show. All right, everyone, welcome back to another episode of On the Margin. Today, I am joined by repeat guest Brent Johnson. Brent, welcome back to the show.
Thanks for having me.
Yeah. So we've got a lot of ground to cover. We were just talking about before we got online here. We almost want to do a tour around the world in terms of currencies. And where I'd love to start is the dollar. So the dollar, has retraced quite a bit this year, found a bit of a bottom around July and has bounced back a bit. But I'd love to just get your thoughts generally on where the dollar's headed.
Yeah, sure. So it's interesting timing because a year ago we were at your conference in New York, and at that time, the dollar was basically near its 30-year high.
Yeah.
Around that same time period, many of the other central banks around the world were in the process of either bailing out their sovereign bonds or dramatically easing their monetary policy in order to support their economies. And at the same time, VIX was at its highest point in 2 years, and U.S. equities, or just generally global equities, were at their lowest point in 2 years. And we were kind of at the point where things were either going to get dramatically worse or they were going to get better. And the central, this is where you kind of got to give credit to the central banks and the monetary authorities, because they came in at kind of the end of October, end of September last year. These foreign central banks kind of bailed out their markets right around the same time. Chairman Powell in the U.S. started to signal that, we were still going to be higher for longer and there were still rate hikes ahead, but, the pace was probably going to start to slow. And so with the expectation of further U.S. rate hikes beginning to slow or fall, and with the actions of the foreign central banks, the dollar pulled back, and it had probably, I thought it was going to pull back. We even sent out a tweet the day of the high saying this was a logical place for it to pull back. I thought it might pull back to the 105 to 107 level. It actually got all the way down to 99 back in July. So it went a little further than I thought. And, but never get these things 100% right. And so, but then, since July, the dollar has started to bounce back, and now it's around 105. So that's a pretty big move. It's up 9 weeks in a row. I mean, so I've even said now it's probably due for a little bit of a breather or a pullback, but heaven help the world if I'm wrong and the dollar just continues to skyrocket here. And again, I think if people were to just look back at last September and where everything was last September and understand that correlated with the dollar being at a 30-year high, you get a pretty good understanding of why the dollar going higher is not a great thing for the world, right? Or at least the world monetary system. And so now we've had that hard sell-off, call it the 15% pullback in the DXY over the last year. And, of course, earlier this year, we had all of the de-dollarization memes came back and all of the BRICS memes came back, and the dollar was dead. And this time it really was going to fall. And right at about the time that kind of chatter crescendo, the dollar turns around and is up 6% in 7 weeks or 6 weeks or 8 weeks, whatever it is. And so I don't really know, quite honestly, where it's going to go from right here. It makes sense to me that it would be time for just a pause or a leap. But here's the thing is if I'm wrong and the dollar, and listen, this is not changing my long-term outlook at all. Long-term, the dollar is going much, much higher, or medium-term, the dollar is going much, much higher. In the really near future, I'm not sure. But what I would say is that, despite all the rhetoric, despite all the memes, there is still an incredible amount of demand for US dollars around the world. And a lot of the times when you see these de-dollarization headlines, there is great desire to de-dollarize, but the ability to actually do it has not changed meaningfully, in decades. And the desire may be higher, but again, there's more US dollar debt today issued by non-US entities than ever before. There's more demand today for US dollars than ever before. And people don't like that. And there's great desire to get away from that, but that's currently the facts. And that is why, despite all the record, monetary involvement and manipulation and money printing and helicopter money, That is why the dollar is still above its pre-COVID highs or its COVID highs. And it's why, despite all of the rhetoric otherwise, the dollar's up 9 weeks in a row. And a big part of that is not just what's going on in the US, it's what's going on in the rest of the world. I
Right.
think I think in many ways people focus too much on the United States. I get why they do, but there's a lot of problems in other parts of the world as well. So I think that the low back in July was probably the low for the dollar. Wouldn't surprise me if it pauses here for a while, pulls back a little bit, but I expect over the next year or so, I think the dollar's got much higher than it is today.
Yeah. So, before we go on to the rest of the world, because I think that's a key part of the story. And one detail, by the way, just in terms of the demand for the dollar, this doesn't necessarily that, when you look at something like global debt or the US dollar denominated debt, that's not stuff we owe everyone else, right? People borrow and lend dollars on their own balance sheets and have their own trading relationships between each other just using the dollar, which I think is a point that often gets lost. But take your point. I want to go out to the rest of the world in a second. I would love to, for folks who haven't heard you sort of break down the relationship in between a country's currency and their bond market, if you could just kind of start with that. And then I would love, to get your thoughts on one of the big news stories, I think, and it's especially been, I think, moving yields on the long end of the curve over here in the US is this amount of supply that's coming online in terms of treasuries and where the market is going to absorb that supply. So you just kind of just refresh listeners on that relationship between a country's bond market and their currency, and then just talk about some of the issuance that's coming out of the US here.
I'm going to say something which I know people aren't going to like, but it's important to understand this. Is there is a relationship between a country's bond market and their currency, and the last thing any country wants to see is the rate that they have to pay on their sovereign bonds to be spiking, because that is often a sign of distress or people wanting to get paid more to hold a potentially defaulting bond. It is different when the US does it than when everybody else does it. Now, it doesn't mean that the US isn't subject to these same issues, and it doesn't mean it can't happen to the United States. In other words, doesn't mean that we couldn't have a bond boycott, but it is different with the United States for a couple of reasons, because we are the global reserve currency. And as the system is designed now, if you operate on the global stage, you have to have dollars to do it. Now, that may change someday, and there's efforts being done to change that today, but those other potential means or distribution systems or monetary systems, however you want to describe that, are not active in a large enough capacity today to change the fact that you still need dollars to operate on the global stage. So that's number one. Number two, with the US, is they are purposefully raising interest rates. They are purposefully tightening policy. They want interest rates. They not only wanted interest rates to go up, but they as of now are still saying we want them to stay higher for longer. So this idea that the rate on the U.S. Treasury going up a lot is a signal that the rest of the world is rejecting the dollar and is rejecting and boycotting U.S. Treasuries. It's just not the case. Now, I know many people want it to be the case, but it's just not the case. Every U.S. Treasury auction over the last, I don't know how many years, has been oversubscribed, meaning there's more demand than the Treasury is auctioning off. And and they're not just meeting the demand. It's over 2.5 times. There is historically about 2.5 times the amount of demand as there is supply for every U.S. Treasury. And as the interest rate goes up, and some countries, that's an indication that you don't want to hold that currency because there's counterparty risk. Again, because there's so much demand for the US dollar and people have to use it whether they want to or not, the fact that you now get paid more to hold the US dollar is like an added bonus. And that is part of the reason the dollar has remained strong, is that when countries around the world, when they get their dollar surpluses from trading with the United States, they either turn around and save those in T-bills or T-bonds or medium-term bonds or long-term. So that is the method via which they hold their surpluses. And so if you get paid more to hold dollars, which you already need, than you do to hold euro, which you don't really need, or yen, which you don't really need, or yuan, which you don't really need, you're gonna go with the one that you need and that pays you more, right? And so capital flows into the dollar, and that has made that has kept the dollar relatively strong versus other currencies. Um, the other thing I would say is that the fall in U.S. Treasury prices over the last year, this should not be a surprise to people. I think it is a surprise to people because we had basically a 40-year bond bull market. And every time we had a hiking cycle, they just didn't last very long. But if you go back to every hiking cycle, when I'm talking about hiking cycle, I mean a Fed rate hiking cycle, when the Fed is purposely raising rates. There's been 7 times the Fed has raised rates since the late 70s. On the other times when they have raised rates, such as they have now, 1978 to 1981 is about the closest approximation to what we have going on now. When they did that in 78 to 81, the long-term US Treasury bond decreased by about 35%. In that case, they took rates from approximately 8% to 20%. So they more than doubled them, right? I think it was like a 200% increase or something, or 150% increase. This time, in 18 months, they have taken rates from 0 to 5.5%. So that's a 2,000% increase, right? So they've taken from 0 to now. That's a huge move in interest rates over an 18-month period. Now, again, going back to the late 70s, they took them from 8 to 20 in about 3 years, so 36 months. So after that time, this time, they've taken them from 0 to 5 or 5.5. In the late 70s, from 78 to 81, when they did that during that hiking cycle, the long-term US Treasury bond decreased in value by about 35%. A big decrease. That is almost exactly what the long-term Treasury bond has decreased this time. As interest rates rise, bond prices fall. So this idea that everybody is boycotting US Treasuries, and that is why the price of US Treasuries has fallen, it's really not correct. I'm not saying that everybody still loves the idea of buying US Treasuries, but this price move, considering the move in interest rates, should not be shocking if you understand bond math and what that interest rates rise, bond prices fall. And I don't have time to go through all the other 7 rate hiking cycles, but suffice to say is this rate hiking cycle is not that much different than the previous 7. It's just that we don't have them very often because we've been in this low growth environment where central banks have not been raising rates, for the last couple decades. But now that they are, it's kind of in line with what has happened before. Now, where does it go from here? Is it possible that things are different this time? Yeah, it's absolutely possible things are different this time. But so far, it is pretty standard.
Yeah. And there's also an element of convexity when it comes to bond math as well. Without going into the details, the move from 0% interest rate, 0% interest rate up to 1% is very different from 6 to 7 or something like that, right? It's there's an element of convexity. I'm always a little bit divided on. I saw someone on Twitter a long time ago said that most of Twitter is just people arguing over different timelines, and I think that applies a little bit to this argument, which is, on a long time frame, I think the U.S. is subject to the same rules of financial gravity that everyone else is to an extent.
Agree.
On a short-term time frame, I don't think that's probably the case just because of our position as the issuer of the reserve currency. It's very interesting. I'll give a shout out to my colleague Jack Farley, who did a great interview with Sir Paul Tucker, who's an ex-central banker from the Bank of England. And just hearing the way that he talked about it, almost like there are 2 types of money. There are many more than even 2 types of money, but really there's sort of commercial everyday use money. And then there's treasuries are in a sense money, and they're interest bearing money as well. And he talked about the relative amount of global demand for non-interest bearing money and interest bearing money. And as you might expect, the demand for interest bearing money is actually much higher because it bears interest. Sure. So, I'm a little torn in between being nervous as a relatively young citizen of the United States about how much debt we're issuing, and it does seem to keep going up and up and up. But at the same time, there's clearly global demand for it, and I like your theory a lot, Brent, as well, which is ancient empires, they sort of used to exact tribute. And a modern form of tribute might end up looking something like, hey, we are leaning on you to essentially buy our bonds and service our debt. So
That's right. And the other thing I would say, and I know we're going to get, this is going to relate to talking about other currencies and economies. The other thing I'd say is that the US has a power that no other country has. And it's not only the fact that there's demand for US dollars outside our domestic shore, that helps it. But because of that demand for US dollars outside the United States, and because the dollar is the global reserve currency, the US can use its domestic monetary policy to great effect around the world. So they can force actions abroad by using their own domestic um, monetary policy. And one thing I would say is that countries around the world store their excess US dollars in treasury bonds. And so as the US raises rates, that makes the value of those bonds that the rest of the world owns decrease in value. And so it's kind of like if the rest of the world is going to sell their bonds when we are raising interest rates, yeah, you can sell your bonds, but you're going to take a haircut to do it. In other words, it's almost like the US saying, okay, you're going to sell them, no problem. But you're going to get 80 cents on the dollar, or you're going to get 90 cents on the dollar. You're not going to sell them for the price that we sold them to you. Right. And no other country really has the ability, at least not to the same level that the US has, to do that. And so this also plays into, these charts that go around that show a decrease in holdings of US Treasury bonds. Some of that is due to sales. Some of that is just due to the value of the bonds going down. And on the periods where it is showing actual sales, these other countries, and I'll use Saudi Arabia as an example because it's the easiest to demonstrate. It's not, they're not selling, or at least they're not necessarily selling from a position of strength. Sometimes they are selling from a position of weakness because they just need dollars. And this is best illustrated by Saudi Arabia back in 20. Yeah, here it is. This is perfect. This is best illustrated by Saudi Arabia in 2020. Everybody knows what happened in 2020. And so some people will look at this chart and they'll see this massive drawdown in treasuries owned by Saudi Arabia in 2020. And some people will say, this is a pure sign that they are selling treasuries. They no longer want to finance the U.S. national debt. They know that the dollar is losing value. They don't want to be exposed to it anymore. Well, what's really happening here, think about where we were at in February 2020. What happened, within the next month? Within the next month, we had a global crisis. Global business around the world shut down. And guess what happened to the price of oil? The price of oil went negative. And who relies on oil revenues more than anybody else in the world? Saudi Arabia. So what happens when you get in trouble and your revenue dries up? Well, you have to start raiding your savings account. So they start selling their treasury bonds because they're running budget deficits. They are no longer, running surpluses. And so they have to sell these things. It's not that they necessarily want to sell them. And so I think it's important to understand that some of the de-dollarization that takes place is not by choice, but it's by force or it's by circumstance. So, what really goes on in all the different cases when people sell treasury bonds, you kind of have to understand what's going on in the country overall to understand whether or not this is a forced sale, whether it's a distressed sale, whether it's by choice, whether it's from a position of power, or whether it's from a position of weakness. But I think a lot of times when people just throw up these charts and it shows this de-dollarization, and that's automatically bad for the United States, it's to kind of get it wrong a little bit.
This was a really good call out, Brent. And by the way, for folks who are following along just via audio, we're looking at Saudi Arabia's holdings of U.S. treasuries going back to 88 through the present day. And for basically between 88 and 04, it was ranging somewhere around 20 billion, but it's gone all the way up. Basically, it's a one-way street up actually from '04 to peaking in just about February of 2020 at 184 billion, and it's down to 108 as of June of this year. But all of Brent's points, there's a lot more that just goes into a very simple chart here, and you've actually shared one other one as well, which is U.S. Treasury holdings of China, and this doesn't take into account the amount that treasuries have dipped. So yeah,
that's the thing is they'll use the chart to show that China's unloading bonds, and I'm sure they have in some cases, right? Again, when you're selling your bonds, that's typically because you need dollars. But what's not typically said when these charts are put up is part of the reason these are coming down is the bond prices themselves have come down. Again, this isn't number of bonds held. This is the dollar value of the bonds that they hold. The other thing that's not clear when you just post this chart is that the Chinese, in general, the government agency bonds holdings have been going up at the same time. So if you adjust for the decrease in treasury price and you adjust for the fact that they're just swapping from one form of U.S. bond to another form of U.S. bond, it changes the story a little bit. And again, this is not to say that it can't happen to the United States. And it's not to say that everybody loves the U.S. dollar and loves U.S. Treasury bonds. But if you're putting your money on the line, it's important to understand what these things are saying, what they're actually saying, as opposed to what you want them to say.
Yeah, I agree. What's going on, everybody? Thank you for listening to On the Margin. I just wanted to take a quick moment to let you know about a very special offer that we have coming out of Blockworks Research. Now, many of you will probably be familiar with our platform, but Blockworks Research is the most blue chip spot to get research, data, governance, models, and a whole lot more about the leading DeFi protocols in the space. I've leaned on our analysts time and time again to explain complicated concepts going on in DeFi to me like I'm 5 years old. They can do the same for you. If you invest in DeFi or are just interested in it, it is an absolute no-brainer. As a listener of On the Margin, and to say thank you all for listening to the show, you can use Margin 10 for a 10% discount, and that gives you access to everything, which would be weekly in-depth reports, live data, all of that good stuff. So again, that's code Margin 10 for a 10% discount. Link is in the show notes. Sign up now. Thank you later. Well, since we started talking about China a little bit, I want to start moving over to that corner of the world. But before we do, I want to stop at Japan. So you and I talked a little bit the last time that you were on the program about the yen. The yen dollar cross, it's been a rough year for that particular cross. And the yen has been, at least for a large period of time, pretty much in free fall against the US dollar. Now, the Japan and the yen occupies a very unique sort of place within the financial world. But I heard you recently talking about there's actually another implication that I hadn't necessarily put together, which is the sort of competition in between China and Japan as trade partners, right? So when you have a weakening yen, it actually puts quite a bit of pressure on China. And the China opening that we were promised at the beginning of this year, or not promised, but at least this was the narrative, that they've been locked up forever and they're going to come back online and it's going to be a huge shot in the arm for the global economy. That clearly has not happened. And if anything right now, I would say the narrative is more that China might be forced to devalue the currency yet again. So you just give us a sense of what's going on in Japan with the yen, and then maybe we can segue our way over to China.
Sure. Well, and here's the thing is it's almost impossible to talk about one country without talking about another. Everything is so interconnected and related to each other now in this globalized world that it's really hard to, so if people think we're jumping around, we're really not, right? It's all related. But I think the yen is really, really important. And it may be the most important currency cross right now. Because the yen is down versus the dollar. I don't know exactly, down 25 or 30% in the last 12 to 18 months, which is an absolutely enormous move for a currency, let alone a major currency like the yen. So the three biggest currencies in the world are the euro, the yen, the dollar, right? And so for a, it's not totally unusual to see a move like this for like an emerging market currency, but for a major currency, it's a huge move. And so the yen has lost value. And part of the reason, again, is this monetary policy divergence between the United States and Japan. What I mean by that is over the last year and a half, the US has purposefully tried to slow the economy and slow the ascent or perhaps even decrease the value of US assets. The reason the US is doing that is because they want to fight inflation. And one of the ways that you fight inflation is, you contract the economy, you increase the cost of borrowing so that the money is not as plentiful. Not only that, but when you raise rates, this is kind of, I'm going to transition to Japan, but I should make this point with regard to the US first.
Yeah.
Because Powell is raising rates, and you may think central bankers are dumb or foolish or misguided or whatever it is, but I guarantee you they understand if they raise rates, the bond prices fall. Part of the reason that they raise rates is in the treasuries fall. When treasuries fall, there's not as much collateral then to make new loans. Decreasing the value of treasuries is a way of constricting credit, which they believe will then lead to prices coming down. Okay. So now let's take it back to Japan again. During the same time that the Fed is raising rates and pulling capital or raising the cost of capital in the United States, Japan has kept on its easy monetary policies. And they have had yield curve control in place for a very long time. I don't even know the number of years. Basically, what that means is that they cannot allow price discovery in their bond market the same way that the US allowed price discovery in our bond market. Because if that happens, then for years and years and years, the Japanese banks, endowment funds, pension funds, institutions bought negative, either zero or negative yielding Japanese government bonds. So if interest rates were to rise dramatically, or even a little bit in Japan, it causes all kinds of problems in the Japanese banking system. But they also are starting to feel the inflationary pressures. And so there's a battle between the currency and the bond. The problem, but as they've kept interest rates low and have kept, monetary policy much looser than the US, that has led to the yen losing value dramatically against the dollar. The issue that they have, and this, I find this really interesting because all of the things that people are worried about one day happening to the United States are already happening right now today in Japan. And that is that they have already had to make the choice. Do we save the currency or do we save the bond market? If they raise rates to save the currency, then the bond market blows up and the banking system blows up. But if they don't raise rates, then the currency continues to slide and the purchasing value of the yen continues to drop. And eventually they get, a loss of confidence in the currency. The problem with trying to fight both of them is that the policies that would save the currency kill the bond market, and the policies that would save the bond market kill the currency. So they're really caught between a rock and a hard place. Now, the other thing I'll say is that in a world where the Fed is the main central bank and all the other central banks are kind of subservient to the Fed because the Fed has the global reserve currency, or because the US has the global reserve currency, and because there's been several cases where countries around the world will use their currency, they will decrease the value of their currency in order to increase the value of or increase the likelihood of their exports. Many countries will get labeled, quote unquote, currency manipulators by the United States. And that leads to either sanctions or problems or, however you want to describe that. But the fact that that has not been said with regard to the yen, despite this huge move, tells me that this did not happen without the US blessing, or without there's no question in my mind that the Fed and the Bank of Japan have been in multiple conversations about what's going on. And I think this is where it gets into with China. As the yen stays weak, the Japanese goods are competitors with Chinese goods, especially in the Asian region. And as the yen continues to fall, it makes Japanese goods more affordable around the region. And as Japanese goods become cheaper and perhaps better made, then if the purchasers prefer those goods. And so then that means less goods are being sold from China. And as less goods get sold from China, that means China's revenues fall. That's bad for China because China is having problems on a couple different fronts. First of all, they have the Chinese real estate market is probably the biggest asset class in in the world. And they have borrowed so much and the debts are so big in that. And now the value of those is no longer rising. So there's tremendous deflationary pressure inside China in their real estate market. As their revenues fall, it makes it even harder to service those revenues than it already was. And it gets it harder to service those loans and to get the prices going back up. And so as the yuan rises in value versus the yen, it makes it even harder. And so I think there's a little bit of gamesmanship going on here a little bit. Um, and so, but China, here's the problem with China's, and this happens in every country, that it doesn't happen in the United States, is that you can have in other countries where their domestic currency is not the US dollar, you can have inflationary pressure in local currency terms and have deflationary pressure in US dollar terms as the US dollar rises. And that is because entities all over the world owe US dollars. So as the US dollar goes up in price, it becomes harder to pay those off. Not only that, but as the US dollar goes up in price, commodities, inputs, food, energy, other needed inputs that are traded in dollars become more expensive in local currency terms, right? And so that's kind of what's happening with China. China's imports, luckily for China, the price of oil has stayed fairly low over the last year. It's starting to rise again now, but it's stayed fairly low. And so, they are trying to deal with inflationary pressures on their inputs because the dollar has gained value, and deflationary pressures in their domestic real estate market. And the weak yuan, or sorry, the weak yen doesn't really help them out at all. And so this is why some have speculated that eventually, in order to combat this deflationary pressure in their real estate market and the fact that their economy is no longer growing at the rate that they expected it to grow, that they may have to devalue the currency. Now, they have tried other things. And to your point, one of the big themes coming into this year was China reopening, right? And China reopening was going to give a global stimulus to the rest of the world. And that's part of the reason, risk assets and equity markets have held up and generally been okay this year, is this China reopening thing. Well, when China reopened and it didn't have much impact, well, then in March or April, now they're going to ease monetary policy. They're going to have a credit impulse, and that was going to save it. Well, that happened and not much happened. Things continued to deteriorate. And now in the last month, now they've done another one. This time it really is going to work, right? The data that just came out last week on China was showing some improvement. So maybe some of these moves that they're doing are finally starting to work. But so far, the China reopening, the Chinese stimulus packages have been very disappointing, not just for China, but for the rest of the world. And again, I think that has contributed to the yuan falling versus the dollar. And it just puts more pressure on both the yen or both Japan and China as the dollar stays strong.
Yeah. It's almost amazing that the global economy has held up as well as it did over this past year. I mean, for the first time in a long time, we actually had a genuine bona fide contraction in terms of the money supply, and perhaps more importantly for the global economy, the collateral, right, in the form of the value of US bonds, which everyone holds quite a bit of. And that dollar wrecking ball that I believe you've coined, we swung it around, and there were a couple of buildings that got hit, some statues maybe here and there, but largely everything has held up.
Can I make one other point before I forget? I apologize for
No,
jumping in,
please do. Please do.
I think this is important to understand. And this is, I think, where people focus exclusively on the US too much and don't really pay attention to the rest of the world. So again, last fall, a year ago this month, China was having problems and was having to dramatically decrease or ease monetary policy in order to deal with their internal economic slowdown. The Bank of Japan had to intervene to support not only the currency, but the bond market. The Bank of England had to go in and bail out the gilt market. And even though the ECB raised rates for the first time in about a year ago, they also set up a facility to go buy sovereign bonds, targeted sovereign bonds, because Italian yields were starting to spike uncontrollably. So that was an example of the strong dollar causing chaos abroad prior to it showing up in the United States. Now, everybody, though, Then we get into this year in March, and we had this problem in the US banks, right? As interest rates continued to rise, that made the bond holdings of all of these banks who had bought very low yielding treasuries fall in value. And that's not a problem when you mark them to market or when you mark them to whatever you purchased them at. But as you have to start liquidating them, now you have to mark them to market. And as that happened, then the balance sheets on US banks, came under pressure, and the US had to set up a facility to offer liquidity to these banks to kind of stop the bank run, right? But again, this started happening abroad before it happened in the United States. Not only that, but the same issues that showed up in the US because of the US banks, because of rising interest rates, these same issues are percolating under the surface in Europe and Asia, because while the US banks bought a lot of low yielding treasuries, the one thing they didn't buy was zero yielding treasuries and negative yielding treasuries, because we never went to negative rates. But you know where they did go to negative rates? They did it in Europe and they did it in Japan. So, and that's part of the reason why Europe and Japan has been slower to raise rates than the United States. And this is one of the points that I try to make. Part of the reason that rates have gone up so much in the United States is because they can, and because the Fed wanted them to. And Powell actually gave a speech. I can't remember if it was a speech or a paper that he wrote about 10 years ago that explained exactly this. As we raise rates, or once we get into a interest rate rising environment, the bonds on bank balance sheets are going to become a problem. And so I don't think Powell is surprised that this happened in the US, and they probably knew they were going to have to do something, which they've done. But the point I would make is, even knowing that, they still raised rates because they could. These other countries don't have the same ability to raise rates. And as a result, they don't have the ability to attract capital to their markets the same way that the US does. And if and when they do decide to raise rates dramatically, either because people no longer want to buy their bonds or because they need to attract capital to their markets, it will blow up their bank balance sheets to an even greater extent than what happened in the United States. Because if you think there's convexity on low yielding treasuries, I guarantee you there's a lot more convexity on a negative yielding Japanese government bond or a negative yielding European sovereign bond. So, just because it hasn't happened yet doesn't mean it won't happen. And I think that's one thing that people need to be aware of going forward. If you think the US is going to get into a crisis because of their sovereign bonds, because they borrowed so much at low rates, what do you think happens when these other countries, get in trouble because they issued negative yielding bonds? So again, it's important to apply the same level of scrutiny on all different countries, not just one country.
I think that's a really good point. And I would definitely put myself in the camp of not assuming that all central bankers are morons, which I know that sounds, a lot of people do. And I've heard it asked on podcasts, very smart people. And the assumption is just that these people don't know what they're doing. And that just has never passed the sniff test with me. That just doesn't feel likely. But I do think, if we're going to talk about global central bankers, one thing, a lot of this, what's complicating this environment of low interest rates is the global phenomenon of inflation. And, my one thing let's refer to the two periods of time in the US where we had inflation that everyone loves to refer to, the 40s and the 70s. In both of those periods of time, we had stop-start inflation. There were broad spikes and then lapses where it looks like we had conquered inflation. In the 70s, Paul Volcker had to actually cause two separate recessions because it looked like we had broken the back of inflation, but then he had to hike interest rates all the way up to 18 or 20% or whatever to finally beat it. And if I just took a really simple reductive view on our current situation, it sort of looks like we're setting ourselves up to do something pretty similar, right? We've got inflation down, but not 100% where we want it to be. If you're Paul Krugman, you can just remove half of the cost buckets that people have to pay, and then inflation's looking great. But for the rest of us, it looks like we are uneasily close to the target, but not quite there. And the ECB, it seems, my interpretation is they've signaled this is most likely going to be it. in the US, maybe what the markets are pricing in now is that we get one more hike in November and then we start cutting rates by about March or April of next year. I mean, what is your prognosis for, have we broken the back of inflation? And then what ends up happening from here inflation wise?
So it's a very good question. And the first thing I'll say is I don't know. And typically when I have an opinion, I don't mind expressing it. But if I don't know something, if I don't know something, I'll just say I don't know. And I really don't. I tend to think inflation is going to continue to come down, but I also think it has the potential to stay sticky longer than ever. There's two camps: one that inflation is going to reaccelerate, and another one where it's going to collapse, and we're going to have this big deflationary credit contraction at some point. I'm kind of in the middle ground. And it's funny because for years, I used to hate people that would say stagflation. I thought it was a total cop out. It was somebody who didn't want to make a call one way or the other. But the further we get into this, I'm actually, kind of changing my mind, and I'm very sympathetic to that because I think in some cases we're going to see deflationary pressures, and in other cases we're going to see inflationary pressures. For me, it's more important to understand what could cause both and to kind of position a portfolio in a way that if you're right, you make some money. And if you're wrong, you don't get killed. Right. And I really don't know which way inflation is going to go. I tend to think it's going to kind of stay at these levels and maybe fall a little bit. I don't necessarily think we're going to have this big deflationary crash, but I understand exactly why we could. And I don't think we're going to have this big, fantastic inflationary spiral higher. I understand what caused it too, but that's not my base case. So I'm kind of in this. I guess my base case is that it kind of continues to trend down like it has over the last year, but maybe not at the pace that many people think it will. And this is probably a good point for me to explain. I think some people think that because I am a US dollar bull, that I'm a US bond bull. Thing is I'm not a US bond bull, but I'm also not a US bond bear. I just really don't know. And here's the thing is if we get into a deflationary spiral, where US Treasury prices spike and interest rates fall a lot, I think the dollar probably does pretty well in that environment because people will be scrambling for gold. If we get a further inflationary push and Treasury bonds continue to fall, well, that helps the dollar as well because now they're going to have to raise rates even more, right? And, in that environment, other currencies probably become even less attractive to the United States. Because what we're not going to have a situation where the US goes into a massive deflationary recession and the rest of the world grows at a healthy rate, right? And so if we get into the situation where either we keep having the higher inflation and the US maintains interest rates higher for longer, that helps the dollar for all the reasons we've already discussed. You got to own dollars anyway, you get paid more for owning them. Or if we go into this, hard deflationary collapse, then we've got demand for dollars because it's the collateral. So I just continue to think that the US dollar is better under both scenarios. Now, the scenario where the dollar is not the better choice is global growth, where things get better. The dollar gets a little bit weaker. Credit impulse from China starts to work. Germany doesn't have quite as bad a recession as that seems that they're headed into. US growth picks up a little bit. Maybe they even go back and maybe they ease monetary policy and maybe the central banks pull off this soft landing. The soft landing is the negative scenario for the US dollar. I think under either other scenario, and by the way, in a soft landing, we'll do pretty good because we own a bunch of assets, right? I mean, that's what you need for the global economy to continue running and for the system to continue running. You need the dollar to kind of weaken a little bit in global growth. Under a scenario where the dollar's rising, that's really bad for the current system. That's really bad for the global economy. So, if I'm wrong and the dollar falls over the next couple of years, it's probably because the global economy's growing and our assets will do pretty well. And so, I don't mind being wrong under that scenario because the size of portfolios are increasing. But I think under either other scenario, either inflation stays high or deflation rears its ugly head, I think the dollar does pretty well.
So do you think we're going to get that soft landing? I've asked it so many times from so many different guests on this show. This year was certainly surprising. I don't think you would have predicted going into January of this year and everyone loves to make fun of the Bloomberg 99% or 100% of economists polled said we were going to get a hard landing. It hasn't happened like that. Okay, we dunk on the economists, but come on, this was common sense that this was most likely going to occur. It hasn't yet. Maybe due to the fiscal that we're pumping in here in the U.S. For whatever reason, right? People have different explanations for why not. The question is what's going to happen from here in terms of a recession, and then asset prices, and those things may be related or they might be less correlated on a short time frame than you think. But where do you think we go from here just in terms of the economy? Did we pass the recession, or is that still on the horizon for us?
So my base case is that regardless of what happens, the U.S. still outperforms the rest of the world. And it is still a preferred place for global capital under either scenario. Now, as far as what I don't think we're going to have is I don't think we're going to have this nasty crash that leads to like a 3 or 4 year recession / depression. I don't think that's in the cards. I do think my base case is that we will get some kind of a correction here, whether it's Q4 or first part of next year into next summer. But then I think depending on what the response to that pullback is, then I think we could go much, much higher in U.S. equities. It will kind of depend on what the reaction is and also what the catalyst is to send markets lower. And again, I'm not convinced that a catalyst to send markets lower initiates in the United States. I think it's just as likely that it happens outside the United States, whether it happens in China, Japan, or Europe. I'm not smart enough to figure that out. I just think that because the U.S. is in better economic shape on a relative basis, that the trigger is likely to come from abroad. But I am of the opinion that asset prices are fairly high. Interest rates have risen a lot. The lag effect is just now going to start showing up in markets. And even if the Fed doesn't raise anymore and just stays at this level, the longer they keep rates at this level, the tighter monetary policy becomes. Because as all of this debt that exists out there gets refinanced at now higher rates, a bigger percent of those debts are going to be paying based on current rates rather than rates where they were a couple of years ago. And so I think that has a natural tightening effect on markets. And so I do think we will, at a minimum, get a pullback. And how far and hard. And here's the thing is, once we do start to get a pullback, I don't think the Fed is going to immediately pivot. Again, I think the Fed wants to fight inflation. I think in a perfect world, they would get 3 to 4% inflation and they would say that they want 2. I think they really want 3 or 4 because it helps them inflate away the debt. But I think that they will continue saying that they want 2. But if they could get 3 or 4% inflation for 10 years, that knocks off 33% of the national debt, and it makes it easier to service. And so, if the point being is if higher rates cause the market to fall, let's say it's a 15% move in the S&P down, I don't think that bothers them that much. Remember, a year ago, the S&P was down a lot more than 15% from here. And so, I don't think that Powell really worries too much of what the S&P does on a day-to-day basis. Now, I will say that if the sell-off or the correction comes to a point which demands their intervention and to say the system, of course they will do it. That is why they exist in the first place. They are there to step into the breach when the system comes under attack, and they will save the system, or they will at least attempt to save the system. So I think when we get this next pullback, whenever it comes, whether it's next week or next year, I think it's going to be really interesting to see whether it's a globally coordinated reaction by central banks or whether it's everybody kind of starts doing the one man for themselves. Typically, it's been pretty well coordinated. I think we're getting into the environment now where it's going to start to be less coordinated and more one-off ad hoc policies.
Yeah, I think that's a really good point. I think it's at some point, right? The central banks have been somewhat coordinated, not always 100% moving in lockstep. Everyone, you don't have voters abroad, so to speak, but I think in general they've been moving in a somewhat coordinated way. Brent,
On that point, let me make one last point on that, and because I think this is really important to understand. In the last 30 years, we always talk about central bank intervention and coordination. Whenever we talk about central bank intervention and coordination, It's always done in an effort to weaken the dollar. They've never gotten together and said, we need to strengthen the dollar. This is really bad. It's always the dollar's gotten too strong. We need to add liquidity. We need to get the dollar lower. All the QE programs were designed to weaken the US dollar. Helicopter money is designed to increase US dollar liquidity. The Plaza Accord was done to decrease the value of the dollar, right? The Shanghai Accord 5 years ago was done to decrease the value of the dollar. All of the emergency programs set up during COVID, that was done to decrease the value of the dollar. And despite all of those programs, despite everything they've thrown at it, the dollar is still at 105 versus its peers, or the dollar index is still at 105. And it's risen dramatically versus a number of other global currencies. It's really important. I mean, part of the reason I talk about the dollar so much is I just don't think there's that much good info out there on how it actually works. And so I'm trying to fill that void. But it's also really, really hard to get kind of your global macro view right if you get the dollar wrong. I just think the dollar is the single most important variable when you're constructing a portfolio. It doesn't mean that I'm recommending that everybody just go out and buy dollars, but you certainly better know what's going on with the dollar, because if you get it dramatically wrong, it's probably not going to be great for your portfolio. And that's why I spend so much time on it. It's the area where I think I can add the most value. They don't need another guy out there talking about gold. They don't need another guy out there talking about equities. So there's plenty of people out there that talk intelligently on those topics. So this is where I think I can provide the most value, and it's why I spend so much time doing it.
It's a really good point, Brent. And even pursuant to the dollar, I mean, one of the variables that you need to understand there is, you tell me right or wrong here, but you kind of have to have a view on inflation. A lot of this comes down to how persistent the inflation threat is going to be, what central banks end up doing, where yields are, and that informs the dollar. That has been the real trick of the last couple of years, because that's a notoriously difficult thing to predict or know. And even if you were to just survey people out there about what caused this inflation, is it inflation? Is it currency debasement? You get many different answers. And the one thing that we haven't really talked about so much is oil. I am a fan of Michael Cow's sort of theory that inflation, even if it didn't 100% originate in oil, that was a big driver for the initial inflation, and then it leapt over into stickier components of CPI. Yep. Look, we drained the SPR. You can't drain the SPR twice.
Right.
And it looks like oil prices are set to rise again. Now, we do have an election coming up, so I wouldn't be surprised if somehow a rabbit is pulled out of some sort of proverbial hat and we make the prices go back down. But I think, that's the last important part of the story that we haven't necessarily touched on, which is...
I'll just make my comment on this real quick, because I know we got to jump in a minute, but I don't think there's too many things that are more deflationary or that are more inflationary than the price of oil. There's a sweet spot for oil kind of between 40 and $70, right? That's kind of the sweet spot. Anything above 70, 75, you start to get inflationary pressures. Anything below $40, you start to get deflationary pressures. My guess is that in the short term, oil pulls back. It's had a really good run here over the last 6 or 7 weeks, maybe 2 months. And I think Biden will probably sell even more from the SPR. But, once we get past that, I think oil is probably going to go much, much higher in the years ahead.
Yeah, I tend to agree with you there. So anyway, additional layer of complication. Brent, thank you so much for coming on here. And I want to give, if folks want to follow you, either with your work as at Santiago, or you have also the hoster of a podcast, which I've tuned into many of the episodes. So if you want to give listeners a little bit of a preview of that, or where they can find you, what's the best way?
Sure. So my friend John Cutsmeta and I, have started this podcast earlier this year. We do a couple shows a week. If you can find it at milkshakespod.com, or even on Twitter, the handle is at milkshakespod. You could find me at Santiago AU Fund, or you can just search for Santiago Capital. I'm pretty active on Twitter, although it appears I may be locked out right now. I don't know what's going on with my account. So I made a joke earlier. If my account starts tweeting about US dollar hyperinflation, I've clearly been hacked. But anyway, I'm pretty active on social media, and my website is just santiagocapital.com. It's really just a landing page with some contact information. But if you'd like to get in touch with me regarding the different services we offer, I'm happy to correspond that way as well.
Excellent. All right, guys. Well, you should definitely go check out Brent's podcast. We'll link it in the show notes here and follow him on Twitter, all that good stuff. Brent, thank you so much for coming on. I always enjoy our conversations. All right.
Thanks for having me.
Cheers.